Hi, I am Anna. I come from www.ntvforex.com. The lesson from contemplating inflation data is that ETA not to be trusted. Analysis http ntvforex.com News ID C0D90B 9/15/2020 12:54:18 p.m. Outlook. This is a big week for data. Tomorrow brings a torrent of mortgage applications, retail sales, the housing market index, and the EIA oil report plus the Fed. See below. Thursday brings the usual jobless claims. In the US, today it's the Empire State and industrial production. Last time the Empire State was an aberrant 3.7 after a decent 17.2 in July, aberrant because other regions did much better, including Richmond. This time it's forecast to rise to 6.8. Don't be surprised if it's more. New York crashed and recovered faster than other regions. Industrial output is forecast up be a lot less than the previous 2 months. Only 1% after 3% in July and 5.7% in June. Manufacturing output is forecast slower at 1.3% after 3.4% in July. Why the WSJ reports equity index futures up on expectations of favorable industrial production numbers is a mystery. Barely in the running. The New York Times reports equity futures rose on good Chinese data. Making the news instead of reporting it, maybe. Be careful what you read on industrial production alone. Bloomberg is gloomy and the WSJ is upbeat. They both can't be right. We guess retail sales are more important than industrial production. The economy is 2/3 consumer driven. The pandemic and unemployment are the big retail sales factors, and expected inflation is minor in that context, but not zero. See the inflation warning below. Inflation warning. The Fed news comes tomorrow at the 2:30 Powell press conference, if there is anything that can be named news. In the grand scheme of things, it's silly to talk about ramping up inflation in the current circumstances. The chart from shows the history of the past decade, using a projection for the current year. 7 of the 10 years have inflation well under 2%. If we understand the methodology right, this chart is based on the year-over-year basis. If a basket of goods cost $1 in year 1 and $1.02 in the next year 2, you have 2% inflation. You could also take all 12 months and average them. Annualization is something else to annualize. You multiply the change in a rate by 12, so if you have 0.3% from 0.1% the previous month, it's a change of 0.2% x 12 2.4%. Annualizing has its virtues in pointing toward a rising or falling trend, while or YY is seeming more static, but deducing a trend in prices is dangerous and not to be recommended. Then there is the problem of components. See the chart from the Bureau of Labor Statistics. Energy is the volatile component. It's interesting that shows the CPI index by month and it has a different feel. Same data, different perception. We're not going to talk about seasonal adjustments, which are easy enough to understand in theory until you try to get a grip on how the statistician comes up with a representative number of how much more a snow shovel costs in December than in July on average over X number of years. One of the most confounding things about CPI is the other adjustments, like the substitution effect. People shift to pork if beef prices go up and adjusting prices for quality as perceived by the statisticians. This is especially vexing because in tech, a key sector, quality keeps rising and prices keep falling in real life. The statisticians persist in showing tech prices higher on that quality argument. Bottom line, the average Joe has no idea what the inflation number is. Most financial professionals don't, either. They count on journalists to get the headline right, even though journalists may not appreciate the statistical techniques, either. What about surveys? The Atlanta Fed survey comes up with business expectations at 1.7% in August. Consumer expectations of inflation are nearly double, according to tradingeconomics.com, and rising, to 3% in Aug from 2.89% in July. This expectation should lift retail sales. The St. Louis Fed has financial market expectations for 5 years out at 1.76%. See the charts. So, the business and financial sectors have 1.76%, fairly close together, but the consumer sees 3%. Somebody is way off base. Even economists often don't have a good grasp of the numbers because of statistical confusion. You can find many learned articles on the internet on why inflation has been below 2% for 10 years. It hasn't been below 2% for 10 years, unless you fiddle the numbers. As for why economic performance growth and inflation are divergent, or at least divorced, we can appreciate the Phillips curve is mostly discredited, but not what supplanted it. Reasons include globalization, trade, technology, and yes, measurement methodologies themselves. The lesson from contemplating inflation data is that it's not to be trusted. We can think of several factors not being priced in today, including ever-falling and lowish energy prices that aid industry but make a speed bump for renewables. Then there's the cost of sanitizing premises, offering virus testing, and paying for vaccines. The government is not paying for vaccines and neither are health insurance companies. If companies don't get liability exemptions, they will have to pay for testing. Bloomberg adds to the discussion this morning with an author's piece on inflation. It starts with the Fed's preferred measure, core PCE deflation. Actually, the preferred measure is plain old PCE deflator, not the core, but never mind. The conclusion: nobody thinks a return to significant inflation is imminent, and nobody doubts that product prices have been under control for a while. Authors includes some other useful discussion in addition to our ideas above, but neglects to mention a critical factor of what traders and investors perceive others as what the crowd expects in inflation. This is Keen's pretty girl commentary. You don't vote for the girl you think is the prettiest, but rather the girl you think the other judges will choose. We can still get a mini panic on inflation. An inflation panic is unlikely, and one of the few things that stands in the way of forecasts of decelerating U.S. growth and thus no or falling inflation. This is bad news for the dollar. Again, it would take a Trumpian shock to rouse the snoozing safe haven beast. This is an excerpt from the Rockefeller Morning Briefing, which is far larger, about 10 pages. The briefing has been published every day for over 25 years and represents experienced analysis and insight. The report offers deep background and is not intended to guide FX trading. Rockefeller produces other reports in spot and futures for trading purposes. To get a 2-week trial of the full reports plus trader's advice for only $3.95. Click here NBSP. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.